How are you doing? Just wanted to really quickly, since you touched base on banking, wanted to understand what is the relationship between banking and real estate, and how do they interplay within the cycle?
Yeah, it's a good question. So, I mean, at least in Western economies, most of what banks do is lend for real estate. So it's a fundamental symbiotic relationship. When you get a property boom, the value of the collateral against which most bank lending is secured is doing well. So banks look robust and they're very profitable. Incentives within banks to do more business encourages more real estate lending. As there is a greater supply of finance real estate against, in most locations, the supply of land is relatively fixed. And so that pushes prices up even further. And so prices become subject to how much banks are willing to lend. At some point, an economy can't keep taking rising rents and rising property prices. There's just too much squeezing going on households and businesses. And so that dries up activity in the real estate market, which then starts to put pressure on prices, which then starts to cause a few defaults. And because banks are then having to manage their balance sheets in a falling property market, some of them start to collapse. Then there's a major panic in the banking sector, and then the economy is starved of credit, and so there's a major recession. And so it's a very symbiotic relationship. It's the property market that brings down the banking system, essentially, and also permits its major rise.
So, Akhil, I guess that answers your question, Naman?
Yes, thanks.
Yeah. So, Akhil, we thought we just present to you a scenario here, and based on certain data from the stock market largely and how it's reacted in the past in correlation with the US stock markets and the news coming out of the US itself. So we are trying to see, would you think that this is a situation where we could say, yes, India to a large extent is correlated more than ever before? We've got a couple of charts which we could like to present to you, and for some reason it's drastically similar. I think Aditya would like to explain some part of it.
Yeah, so in this first chart we see that...
Sorry, Aditya, just one sec.
Yeah.
Harish, if you can make it maybe full screen or just maybe make it bigger. Is it clear to everyone?
Yeah, cool. I can see that.
So
Okay,
the chart basically highlights the RBI interest rates, which is in blue at the bottom, and the stock market, which is at the top. And we can see that the RBI increased interest rates about 4.8% 18 years ago, and the reaction was a 400% rise in stock markets following that. We're at a similar point right now, where it's about 4.8%, and we're expecting the RBI to again increase interest rates. So how do you see it going forward from here?
Well, I don't think the causal factor is because rates rose, stock prices rose. I just don't know. I don't think there is a causal relationship, but we are at the point in the cycle where prices should be rising, and the stock market rides the cycle up to a peak, as I showed with the Dow Jones since 1800. And so as it did in 2004 to 2007, I'm expecting exactly the same in 2022 to 2026. So yes, I do think it will be a repeat, and it will be against the backdrop of, possibly rising interest rates. It may be that, we've seen the worst of the rates, at least in the US now, or at least it seems that the market reaction to the Fed's announcement yesterday suggests that it was already priced in. So there was a bit of a rally out of the lows. I don't know if the lows are necessarily in, but it seems that we're getting close. US markets tend to lead others, as I've said. And I expect US markets to boom quite significantly. If you're a technical analyst, actually, the chart of the Dow Jones and the chart of the BSE Sensex is actually incredibly bullish.
Yeah, I think Naman, you had something.
Ricardo, could you just go to the next slide?
Harish. Sorry to cut you off, Akhil. But in line with what you were saying, and Naman, you had an observation about this.
Yeah, I just wanted to add, Akhil, a lot of us might not remember a lot of the funds and finance companies started investing heavily into real estate around, the 2004, 2005, time frame. which we may remember as like the mall craze, and thereby Indian real estate saw a similar boom and bust to the United States. So if you can just add a bit on this.
Well, there's always something, there is some asset which absorbs the capital, because that's where people are feeling the demand is. So malls, yes, I remember seeing some in where my grandmother lived. She's now passed away sadly, but where she lived, a lot of them opening up. I don't know enough about the real estate market now to know what that will be this time around. It might be something else. It might be related to technology. This is how technology might affect the cycle. So, if there's new demand for locations based on a different technology, I don't know. But there's usually something. In the UK, we're seeing a big boom in logistics centers because online economy is developing. So you need space to store goods in local locations. There's actually been a bit of a revival in smaller town centers because people are moving out and can work remotely. So that's changing the patterns, but there's always something that happens over the course of an 18-year cycle.
I think what we're just to show how well correlate. Yeah.
Sorry. Ricardo, you want to say something on this? Or?
So yeah, so we also have something called a housing index, and it's at a relatively infant stage still. Started since 2012, but it's been seeing steady growth. And while it's not on par with UK housing, the UK HPI and the US HPI, it has recovered from its COVID lows. Do you think the graph represents something of past which might be correlatable?
Well, I mean, it's difficult to talk definitively about a specific cycle in India without, obviously seeing data and knowing the history. But if you were just to present to me this looks very correlated to the US and UK real estate cycle. So you had lows around 2011, 2012, and if the data series went back a bit further, you might find the same thing. I presume that housing prices weren't going up and probably were going down in 2008, 2009, 2010. So you had a low around the same time. Then you had several years of expansion up the first half of the cycle. You had a peak in 2019, and then prices came down a little bit, not 10, 12, 15%. And as you say, because of government actions, the end of the recession, the opening up, things are starting to recover, and you would expect things to continue up. On the whole, of course, local markets, local supply and demand factors, local availability of financing, all those play a part on specific business decisions. But in aggregate, you would expect housing prices to continue up for the next few years. So just on the basis of that small data series, it looks quite correlated to me. I've done a little bit of research on Indian real estate. It seems there was a bit of a financial crisis in 1993, just after sort of liberalization started. There was also a bit of a quite a significant financial crisis in 1973. Suggests to me that actually, despite the fact that, of course, India's approach to business and to the economic policy has changed very significantly over the last 50 years. It suggests to me that actually, on the whole, it's fairly well correlated with kind of large Western economies. And I know now India's larger than most Western economies. And actually, you'll see the same kind of timing as well. But, that's a working hypothesis. We actually have to see how, in the absence of data, how it actually plays out in practice. The great advantage for a business owner in India now is having seen the history in the US and the UK, knowing that it may be correlated, and then being able to watch what's going on there to get some sense of how things will play out in your own locations.
Right. So Akhil, we have the next two slides, which represent a little bit of the correlation of the past few years. And one interesting thing that we found out was, yes, India is correlated to the rest of the world. And when you look at the price index, and especially the price to income ratio, I don't know if Harish can pull that on the screen. What we found that Bombay, Mumbai, and a lot of the other capital cities of developing nations seem to have more expensive real estate when compared to the developed nation counterparts. Why do you think real estate is much more expensive in developing countries as compared to developed nations?
I don't have a definitive answer to that. I think probably that in a lot of countries, it's seen as the ultimate store of value. And so people are prepared to pay much more than they would be in other countries. There's the issue with cost of housing, and we're talking about housing affordability, so price to income ratio. The problem with that sort of comparing those data points is that there's no absolute level where housing is unaffordable. So you get much higher ratios in China than you do, China's, number 3 and number 4 in the list than you do in the UK or France, even though prices are ridiculous in the UK and maybe not so much in France, but in the UK certainly. So it's I think in emerging markets it's more of an asset where you not only it's for shelter, but it's also a store of value. There are maybe fewer other assets you can park your money in. I don't know if that's necessarily true now, but certainly with older generations, you certainly see those sorts of effects. And you saw that to a certain extent in places like Greece in the 2000s. And of course, Greece had a major property boom into 2008. Does that answer your question?
Yeah, that does.
So, Akhil, some of our members have just tweeted out not tweeted out, but I think they had posted another question in their sign up form. That being largely is we've seen a tremendous pressure on rising input costs into real estate, especially in India. We're looking at an average of about 20% overall increase in the cost of construction. Certain markets themselves are tackling labor issues, like I know Ireland and America and to some extent Australia as well are tackling labor issues. What do these issues, which actually sort of inhibit real estate, what role do they play in the cycle? And is it just a way to inflate pricing over time, or what is your view on things?
I mean, I think some of that is it depends on where you're talking about. So when prices rise, let's take different inputs. When the price of land rises, you tend to have to use it more efficiently. So you cram as much as you can onto a particular site within permitted regulations, and you shrimp on costs. So you make the build quality a bit lower. You see that quite a lot in the UK, for example. So all I'm saying is that this isn't a fixed thing. It's a dynamic industry, and different decisions are made based upon different input costs. And so building costs is one of those input costs. I don't know quite how it plays out in different countries. I think that depends on various local circumstances. I do know, for example, in the US, yes, they are having trouble with housing supply, but the reality that is made is that people want to move, people want to live somewhere else, people want to buy, and that is putting upward pressure on prices, which normally ultimately will induce a bit more construction. But the interesting thing about the housing industry is that additional construction never seems to reduce prices, because, of course, as you know much better than I do, one of the skills of being a developer is to feed stock into the market without crashing the price. So you have to do it carefully. And so some of that adjusts. So we might not see necessarily quite the same levels of increase as we've seen out of the pandemic, which was very much demand driven. But I'm sort of expecting that, subject to some kind of resolution or stalemate in the Ukraine-Russia crisis, and hopefully China unlocking its economy, which has I think probably even greater impact on global supply chains, given the importance of Shanghai to the global shipping industry. I think inflation will hopefully start to come down a little bit. Certainly commodity prices have fallen fairly significantly in the last few weeks.
Aditya, you had something you wanted to...
Yeah, so we've seen recently the Feds have been increasing their interest rates. So we saw a 50 basis point increase in May, 75 in June, and then a further 75 points as of yesterday. In India, the Reserve Bank itself has been following the Feds and has been raising interest rates. You've studied the 1980s inflationary crisis. How do interest rates tie in as a tool to deal with inflation? And how do you think that will affect the cycle?
Well, it worked in the 80s, raising rates to that level. I mean, you basically, the chairman of the Federal Reserve had to create a relatively significant recession in order to do that. Potentially Powell is doing the same thing, but I'm not quite sure he's really doing it to the same extent. And there are supply factors, which I've just mentioned, which I think will help to bring inflation down regardless of what the Federal Reserve does. In terms of the cycle, well, in moderate to low to moderate inflation, I'm never always sure what economists mean when they say moderate inflation, what number that means. But in moderate inflationary scenarios, real estate is the asset to own. Real estate and stocks of companies with earnings, with solid earnings, particularly where you can pass on price increases to consumers. There aren't too many other assets to own in such things. I mean, in such scenarios, bonds tend not to be great until you've, of course, got bonds which have a suitable rate of interest. So not, otherwise the capital value is eroded. People talk about gold being an inflation head. It's, not done so well the last year, despite the fact we've had very significant inflation. So it's not always a given. Commodities, of course, are another inflation hedge. So there are things that you can invest in, and real estate is one of them. So it should mean that real estate markets hold up until, of course, if people are on variable rate mortgages and suddenly interest rates go up to 10% from 2%, that's of course going to have a major effect. But the transmission of higher interest rates into the economy is not always very swift. It takes several months, and it's not quite the tool that I think central bankers think it is. So that's kind of my view of what inflation will do and how it will affect the cycle. The other thing to mention, I should have added earlier, is that actually banks want higher rates of interest. It's very hard for banks to make any money when interest rates are at 0%, as they have been in Europe and the US for a very long time. And I noticed the share prices in a lot of banks have, at least in the US, maybe not so much the US, but in Australia and the UK, have held up fairly well over the last few months, as the full scale of the conflict has become apparent. In other words, where it's sort of limited to and so on. And so the other thing that fuels the second half of the cycle in particular is the availability of bank credit, as I've mentioned. And so if banks are making money, they're better capitalized, they're more willing to lend, and that can fuel a boom. So actually, I don't see inflation particularly being too much of an issue for the second half of the cycle, at least from a real estate point of view. Now, again, subject to specific conditions. I'm not an expert on the Indian banking system, I'm sorry to say, so I don't know if there are the constraints on the supply of finance, etc., which would affect things a little bit. But those are the major sort of underlying dynamics.
I know you touched base a bit on, COVID being a factor. Just if you can elaborate a little more on how it affected the cycle, and whether there'll be any long-term effects because of that.
Well, there have been a couple. Long-term, yes. I mean, there's always a long-term effect of pandemics, but in relation to the cycle, there have been a couple. So, my sort of contention is that we were slowing down into a recession or a slowdown at the end of 29 anyway. What the pandemic did is we basically were asked to stop doing everything, work from home where we can, but very major disruption to the economy. But the public policy response to that in most countries, both developed and emerging markets, was to enact one of the biggest fiscal stimulus programs we've ever seen. And that a lot of that was direct to households, at least in the UK and the US. And that created a massive increase in the rate, in the savings rate, which when economies started opening up, meant there was a huge surge in demand. But the supply side of that was not able to respond because, lockdowns were still happening. And so I think this is one of the contributory factors of inflation, which is one of the reasons why the chairman of the Federal Reserve for quite a long time was saying that inflation would be transitory, partly because he expected supply side to respond. But of course, we hadn't had second lockdowns and China third lockdowns and so on. And so it wasn't so easy to get that side. And then, of course, on top of that, the Ukraine disruption. So COVID has disrupted supply side of the economy, and it's also created enormous demand because of the nature of the stimulus packages. This will have quite a long-term effect. It will take some time to play out. The other thing it appears to have done is firstly take a lot of people out of the labour market and then brought a lot of people back in, but maybe not quite to the same extent and not enough to meet this additional demand that we saw in 2020, 2021. And so there's been quite a significant rise, at least in certain industries, in wages, which of course has an effect on pricing and so on. And interestingly, the consequence of a lot of pandemics is that wages increase. Might be because a lot of workers have died, and so the ones that are left are being chased, and so you have to pay them more. But also in this case, it's changed the composition of the labour force. It's changed where people want to locate, and so on, and so adjustments have had to be made as well.
So, Akhil, if I could just, one of the questions being asked in this particular forum is, what do you think is going on with the Chinese real estate situation right now? And how does it affect the larger global property market?
Yeah, this is a question. I don't really have a very clear answer to this, I'm afraid to say. So, at the end of last year, with Evergrande about to default on its loans, people were saying it was a Lehman moment. But, the Lehman moment happens at the end of the cycle, not the mid-cycle. That's the first thing to say. The second thing is, the Chinese government is in control of its economy in a way that most Western-style countries are not. And it can direct people to stop buying, it can direct people to buy, it can direct lenders to lend, it can stop them doing so. And so it appears that it has contained the problem without, of course, solving it, because you can't solve it when a big company is over leveraged and so on. It's not so easy. So I do think that it will have an effect in the Chinese real estate market. Whether it has an effect globally, I don't know. I don't think so, but it certainly hasn't so far. What I think the outcome of all of this in the next couple of years is it won't create a major problem. Then people will think, well, the Chinese government is all powerful and can control its economy. It will give investors in China more confidence. They will go in even harder. Chinese banks will be going abroad. They're already abroad, but they'll be going abroad in even greater numbers, the Belt and Road Initiative and so on. Some property markets outside of China will be quite dependent on a flow of Chinese capital. And at some point, the Chinese government, when things have become over-leveraged in China, and probably at the same time as they become over-leveraged in Europe and in North America, the Chinese government will take some measures to stop that flow of credit outside and maybe tell banks to capitalize more and so on. And they will have to respond, because you have to do that sort of thing in China without fail. And that might be the thing that precipitates the next crisis, because when you lose credit from an economy and you're dependent on it, it can have very significant consequences. And the thing is, because we are now much more, at least from a financial point of view, much more globalized, that could have ripple effects all around the world. And so that is my prediction for how the Chinese real estate and banking sector might influence the rest of the cycle.
Thanks so much for that, Akhil. We're drawing close to an hour, which is what this session was supposed to be. A few closing notes, if I could put, take advantage of your goodwill and extend this session. Property share market economics runs a service. What is the advantage of this service? Why should I be interested in it per se? And how is it different? How do you guys tend to help your members?
Well, I mean, you should be interested if you've found what I've said useful. If you thought it was a load of rubbish, then probably it's not for you. So what we do is we track the cycle, particularly in Western markets, but we're increasingly looking at places like Japan and India and other places, and hope to do potentially more research with you to develop sort of local indicators to track the cycle in India. What we do for our members is market commentary. We have proprietary indicators that we use to show them where they are. We filter out the news and we relate it back to the cycle so people don't get too scared by, let's face it, fairly hysterical headlines in the newspapers all the time, giving, knocking your sense of balance all over the place. We produce an annual stock market forecast for the US, Australia, and the UK, but other countries if we can find the data. So we'll try Japan, etc. And that has proven to be fairly prescient. So we were telling our subscribers that the high for the year would be around February, March, and that we'd have a pretty significant low in the middle of the year. So we've been pretty accurate, and this is not the only year we've been accurate. We tend to have a fairly good model for the stock market, and so that can be advantageous. And then we keep tabs on what's going on in real estate and in markets and in the banking sector to check that the cycle is on track. So really, the advantage is you have a sense of security that what's going to happen, that we will have your back and telling you when things are turning down, and hopefully some ideas for how to take advantage of the cycle from a real estate or a stock market point of view.
Great. So just adding on, as developers, we are driven by constant need to just acquire, right? How do you and property share market economics suggest a real estate developer or to navigate through the booms and the busts? That's the first part of my question. And without getting into detail, how does property share market economics strategize for a developer, or the strategy for a developer differ from the advice on the ground level or the ground reality?
Well, I think you sort of answered your own question. So it's all very well buying and buying and buying, but at some point you have to stop. And so we will tell you when that point is. Essentially, we're not going to tell you, you should invest in this district or that district because you know much more than we do. We can tell you that, of course, if they've expanded this, the city limits, and if they suggest they're building train lines and roads out to districts, we can provide advice on the basis of what we've seen in previous cycles. Is that the cycle always ripples out from the center to the outlying suburbs and outlying regions in the second half of the cycle. They increasingly go to areas where there's a thinner population, thinner demand, which is much more volatile. So it goes up much more quickly in the second half, but also comes down much more quickly when the crisis happens. We can also, and I think this is the real advantage of being in India and other countries compared to the US, is that we particularly follow what's going on in the US, not least because it's still the world's largest economy and the world's most significant financial market, but also because it tends to lead the cycle. And so what happens in the US 6 months in advance will happen in the UK, which will happen 6 months later in other parts of Europe, and potentially in emerging markets as well. So you've got plenty of advance warning, which is important for a real estate developer, because of course, if you've got stock to shift, it's not like you can just sort of sell it straight away. You need to prepare, 2 or 3 years in advance to be ready, and that can sometimes involve some difficult decisions. Sometimes foregoing business, not starting projects, not taking on additional staff, which might seem like a ludicrous thing to do at the time, but actually means that you're prepared and protected when the crash happens.
Akhil, in consonance to what you said, Harish, could we just have that last chart where just for our members out here? And I don't want to spend too much time on this, but just to highlight how relevant that information. Harish, are you there? The last slide, please. The last slide. Yeah. So this is Mumbai, and then the extended suburbs of Mumbai, which is Panvel, and Thane, which is called the MMR region. Harish, back to that slide. Ironically, in line with what you said, Mumbai, Thane, and Panvel, these three, Thane and Panvel are extended suburbs of Mumbai, essentially, in some way. And they've grown far more than Pune, which is more like an isolated developed city or developing city. And, it's the sheer amount of infrastructure being built to connect to the main city, which sort of has prompted this kind of growth. But yeah, that's just a small point I thought we could highlight, and we could thank CRE Matrix, our knowledge partners, for this. Aditya, you had something you up your sleeve you wanted to share?
So one last question from my side, Akhil. I've been quite addicted to Phil's book, which is The Secret Life of Real Estate and Banking. Sorry, I'm bringing this up again. And I believe it's one of the most comprehensive readings in real estate that I have gone through. I now hear that someone else is also coming out with the book soon. So if you could just talk us a bit about that, and also how does your book differ from Phil's work?
So the great secrets is that I'm writing a book, or I've written one. It's now with the editors for editing. So it's called The Secret Wealth Advantage. And essentially what it does is unlike Phil's book, which provides a comprehensive history of the US real estate cycle since 1800 and shows you, I think you'd agree, in quite some clarity how the real estate cycle repeats. I take a lot of that knowledge as given. What I do is I break the cycle down into about 8 stages. And I illustrate each stage with a different episode from history. And I tell people, here's what you need to look out for at this stage. And then I give them a set of investor actions or business owner actions to take advantage of that phase or to protect themselves. So for example, the mid-cycle slowdown, one of the actions is make sure that you have a lot of spare cash if you're a business owner. Make sure you're not over leveraging. Make sure you can cover your loans. Make sure you haven't overexpended your staff such that you might have to fire some of them, etc. And the advantage of that is when things come crashing down, or not crashing down, but when things come down in the recession, people who have gone over the top have to, they lose market share, and you're in a position to expand because you've got cash and you're prepared. You can grab that sort of share off them. So it's things like that. It's how to take advantage of the cycle stage by stage. And then in between all of those kind of sequential practical chapters, I also explain why the cycle happens, why land is so important to the cycle, why no one sees the cycle, how commodities play in, how banks and government spending has an effect. How when the banking system has been rescued, because that has to happen at the end of the cycle in order for the next one to begin. So it sort of explains the cycle, educates people about it, but then also tells them what to do.
Wow, sounds really interesting, and a cheat code in the true sense for, I think, all of us. So I think on that note, we're super excited to, for your book launch. And hopefully when you're done with that, we'd urge that you do come visit us in India. We'd love to host you. And just on behalf of the developer fraternity and CREDAI MCHI, we'd love to hear more from you and the different phases of the cycle. So we're eagerly awaiting your book launch. And I think never before you've kind of opened our eyes. We've realized about the cyclical pattern and nature of our businesses. So thank you for that. And I'll just hand it over to Ricardo for the closing remarks.
Yeah, I think we've already extended our time, Akhil. A big thank you from all the developers from CREDAI MCHI, CREDAI National. Thanks for taking out time. We hope we can host you, as Naman said, at some point in time. If you're doing a book launch tour, that would be fabulous. And maybe we could also toast you more than just host you. So on that note, Akhil, anywhere we can reach out to you. I know a few people have their questions unanswered. So how could they reach out to you? And if you'd like to drop that bit of information.
Probably the easiest way is if you email the team. So info@propertysharemarketseconomics, all one word, .com. And let them know you've got a question for me. I'll get it that way. And as I said, you're welcome to become a subscriber. There is a free newsletter, so you don't have to pay any money if you don't want to, or until you're ready to. So if people want to keep up to date with some of our thoughts on a weekly basis, you can sign up to our blog, which is available via the website. And of course, if you're more interested in knowing more, then you can become a subscriber as well.
All right. On that note, thank you once again, Akhil, and hope you have a good evening or good day ahead. I don't know where have you joined us from, because you've been super secretive about that as well. So,
I'm in London. It's
you're in
2:30.
London. Oh, okay. So
Yeah.
good day, hopefully ahead.
Yeah.
All right. Thanks so much. Thank you everyone from CREDAI MCHI, CREDAI National, for joining this session. We hope it was informative. And if you would like to message your question and we could take it forward into a more consolidated form to Akhil, maybe we could try doing that at a later time as well. Thanks everyone, guys. Have a good evening.
Thanks for watching. Want to know more? Join our Property Cycle Investor newsletter. You'll get exclusive access to our new uploads on YouTube. Did you miss the first part? Go here. Click here to watch our other videos.